Welcome to this week's Sustainable Finance Research Seminar. I'm very glad you're here. I'm happy to have with us today Jonathan Berk with his paper, The Impact of Impact Investing. So just to reiterate the usual ground rules, we've talked to Jonathan. He's fine with you asking questions all the way during the talk. And he'll handle that on the fly. So just unmute yourself and speak up. We'll have until 5:15 in Swiss time, so roughly an hour. And after that, we'll transition to a more informal mode and stop the recording. Right now, the session is recorded, just so you're aware. Okay. And with that, the floor is yours, Jonathan. It's great to have you here, and we're all looking very much forward to your talk.
Okay, well, thank you for inviting me. Yes, let me emphasize to you that I don't like talking without anybody reacting. So very much prefer it if you would just interrupt me. And don't expect me to see raised hands. I'm not that good on Zoom. So just unmute yourself and interrupt me, and I'm very happy to take questions. Okay, and if you don't do that, this will be over early. Maybe you want to go to your holiday party, but assuming you don't, you better interrupt me. All right. So this is joint work with Jules van Binsbergen, and let's just start where why is this not moving forward? Let's see if this will make it move forward. Interesting. All right. So let me just start where we started on the where we began this investigation, which was on the question of, so you have all this move towards people divesting from dirty companies, and the first question you need to ask yourselves is, well, how would this affect social outcomes? Why would divestiture make any difference? And on a very superficial level, you say, well, how could it possibly make a difference? If you swap one owner for another owner, why would that make any difference to the operation of the firm, or why would that affect the social outcome in any meaningful way? And so in order to think about that, there are two possibilities, two indirect channels that this could affect social outcomes. The first is that there's a change in the preferences of investors, right? And to the extent that investors, equity holders in particular, run the firm, if you switch one set of investors for another set of investors, then that's going to change the preferences of investors and could change the strategic path of the firm. Now, the only problem with that argument is it seems unlikely to result in any positive social outcome, because if the people who care about the externalities are selling, that means you're swapping people who care about the externalities for other investors. So presumably that means the number of investors who care about externalities goes down. So it's hard to see how that could lead to any social change in the firm that would be in accordance with some kind of social good. So it's hard to see how that channel would affect the outcome. So there's only one channel left, which is that it affects the cost of capital of the firm. So how does that work? I don't know why only one, why it is not interesting. I can't. Okay, there's only one thing I can do to advance the slide. It doesn't matter. Okay, so how would divestiture affect the cost of capital? Well, when one investor sells, if we're in equilibrium, and one investor wakes up one day and says, look, I want to sell, he has to induce somebody else to buy. And the way you induce somebody to buy is you lower the price. So if there's a bunch of socially caring investors who decide to divest themselves of a dirty stock, then they all will then sell the stock. In order to induce other investors to buy, the price will be lower. All else equal, that means the cost of capital of that firm is higher. If the cost of capital of that firm is higher, that means there are fewer positive net present value opportunities for that firm. And obviously, the firms that the socially caring investors buy, those prices are now slightly higher. So those firms, their cost of capital is lower. So they have more positive NPV projects. And so what that means in the long term is that the firms that are deemed, that are selling, the dirty firms, have less growth opportunities, and the clean firms have more, which means the dirty firms will grow slower and the clean firms will grow faster. If you wait long enough, the world will become clean, okay? And so that's the only mechanism you can think of which divestiture would in fact have a positive social outcome. So the key insight here, though, is that for this mechanism to work, it is essential that you see a change in the cost of capital. So if you don't see a change in the cost of capital, this isn't going to work. And so the focus today is that question. Have we seen, or is there, from a point of view of what we know about the economy, could we rationally anticipate that a divestiture campaign could change the cost of capital in a large enough way to affect social outcomes? And so that's the goal for today. All right, so let me outline the plan that I have in mind. So I'm going to do this from two perspectives, okay? I'm going to do this from a theoretical perspective. What I'm going to do is build a model and ask the question, what do we expect to see? And then I'm going to do it from an empirical perspective. I'm going to take the predictions of the model and see if they're validated in the data. So it's going to be a dual approach, and you're going to see that both approaches give the same, are consistent with each other and give the same answer. Now, I've gone through academics for 30 years. We've gone in various different ways of presentations, and I've come to the view that when presenters get up and say, oh, I need to tell you my results before I start, that just leads to bad outcomes, because if I start telling you my results, then people will get hung up on the results. They haven't seen the model. They hold up the seminar. And in fact, the goal, or what people want to do, which is, okay, I want to get my results in case I never get there. You never get there because you give the results, but because you never really justify the results, nobody takes it seriously. I think that's a bad strategy. So I have come to the view now that I'm not going to do it anymore. So instead of that, I'm going to present the model, and then you'll see the results, and then we'll discuss. Okay, so with that in mind, let me continue. I just want to make sure nobody has any questions at this point, right? Okay. All right. So now, if you want to talk about, okay, let's see if I can get this to work. Yeah. If you want to talk about a theoretical model, and you want to talk about a theory of how trading and preferences affect prices, then as far as I'm concerned, the place to start is the capital asset pricing model, okay? And it's the workhorse model of finance. So within that model, let's just ask the question, what do we expect to happen? If a group of investors decide they don't want to hold a set of stocks, how will the world change? And so that's the first step. Okay, so I'm going to build the model as follows. It's a single period capital asset pricing model, perfectly standard, where all investors have mean variance preferences. I'm then going to compare two equilibria. I'm going to compare the equilibrium when all investors are identical to an equilibrium where a fraction of investors have what I call ESG preferences. And what that means is they just refuse to hold stocks. They impose social and environmental costs. And I'll call these stocks dirty stocks. Not that I think they really are dirty, but it's a nice way, because they're clean and dirty, it's easy to remember. Okay. Now, let's think this through from a big picture standpoint. If I have a set of investors who refuse to hold a set of stocks, then obviously those investors will be on their own mean variance efficient frontier, right? And so they'll have a mean variance efficient portfolio. And then the rest of investors will be on the mean variance efficient frontier of the economy as a whole. And so, and then what I'm going to do is I'm going to say, okay, what does this economy look like and how do prices change when the set of investors, when one set of investors artificially constrain themselves to be on a mean variance efficient frontier that's clearly going to be internal because it's a constrained mean variance efficient frontier. Okay, so now, there are surprisingly so many papers out there that have done this exercise, and you can look in the paper and you can see all the references. What is a little surprising is some of them, when they do this, are not very careful about exactly what is exogenous and what is endogenous. Obviously, the capital asset pricing model is an interesting model in the sense that we talk about returns and we talk about means and variances of returns, which is not really so standard in economics because the means and variances of returns are endogenous quantities determined in equilibrium. And so if you want to specify the model, you can't specify the model in terms of equilibrium means and returns. So what I need to do first is clearly lay out what's exogenous and what's endogenous, okay? So let's just go through the exogenous assumptions. The exogenous assumptions are A, that investors have mean variance preferences, okay? So they maximize the expected return of their portfolio, subject to a level of variance, or they maximize the expected return minus some constant times the variance of the portfolio. There are two kinds of stocks. They're clean and dirty stocks, and there are two kinds of investors. Gamma fraction are ESG investors, and 1 minus gamma are the rest. Okay, now the exogenous assumptions. So we need to, when I go from one equilibrium to another, I've got to make sure that I keep the exogenous assumptions constant, right? So you have to be careful here. You can't go from one equilibrium to another and then start holding returns constant, because obviously returns are part of the equilibrium. So we're going to assume that every firm is going to pay a liquidating dividend. I'll denote with a DE as the liquidating dividend paid to all investors holding the clean portfolio, and DD as the liquidating dividend paid to all investors holding the dirty portfolio. I will talk about more about that in a second, but you can imagine you can clearly define the set of stocks that clean investors hold and dirty investors hold, and then define the liquidating dividends of those stocks. And I'll come to that in a second. Okay. I'm going to adopt the price normalization. The market portfolio has price 1. You'll see that's actually pretty convenient. It makes life a lot easier. Now, in equilibrium, there's going to be...
May I ask a question, George?
Yes. Yeah.
Hello. It seems to me you're separating the two types of investors. So you have ESG and non-ESG investors, but the non-ESG investors could as well hold ESG stocks, right? I mean, here
the non-ESG investors hold ESG stocks, but the ESG investors don't only hold. So the only difference is ESG investors only hold ESG stocks. The other investors hold all stocks.
But in your previous slide, you said the 1 minus the non-ESG investors hold the rest of the stocks.
Yes. So they hold the okay, so let me be very clear here. The dirty portfolio can have clean stocks in it.
Okay. Thanks.
Right? It's always defined on the clean, right? But good point, George. Okay. Okay, good point. Okay. Okay, so because the price normalized, because the market has price 1, the total value of all stocks, which is the market, is also the total value of the sum of the clean and dirty stocks, which means the clean and dirty stocks have value 1, which is nice because it means that VE and VD, it can easily be interpreted as the fraction of wealth in clean stocks and the fraction of wealth in dirty stocks. And as George points out, when I say clean and dirty like this, I mean the stocks that the the rest of the world holds. So it's possible for the dirty stock portfolio to also contain clean stocks. It's just not possible for the clean stock portfolio to have dirty stocks in it. Okay. So then you just define the returns of these two portfolios, and then the return of the market is just the sum of the two returns, and multiplied by the fraction, which gives you the return of the market as just the liquidating dividend of the two portfolios minus 1, which is really convenient because, as you can see there, the return of the market portfolio is then an exogenously specified quantity, right? Because of the price normalization, the return of the market is exogenous, even though, of course, it's determined in equilibrium. All I'm saying here is all other prices are determined in equilibrium. So this one price that I normalized is not, and that makes life easy. Of course, that means that if the market portfolio is the price normalization, the risk-free asset is not, and so the risk-free return is determined in equilibrium. And so we have to be careful with that. Okay. All right. So
one question, excuse me, Jonathan.
Yeah.
Is it right that the firms don't change?
Firms don't change.
Okay.
Yeah, they do not change. This is why I'm being very careful here. There are other papers in this literature, one in particular that isn't so careful on this. Okay, so
Jonathan, hi.
Yeah.
Just a quick question.
Yes.
What do you think? How critical is the assumption of a one-period model, given that you could argue that the cost of capital will change for these dirty firms in the future? And here you assume, we'll take the dividend as a exogenous variable, but if you would move to a continuous time kind of model, then also the dividends will be affected for these firms, and then the effects will be much heavier on these firms, probably. I don't know, but
yeah, I'm not sure, and I don't want to speculate. Let me say this. You could always think of the capital as the Merton model as the continuous time version of the single period model. You don't get, the only difference is the hedging, the investment opportunity set. So to the extent that that would affect things, it's hard to see why. But with all that said, I'm speculating. The one thing I will say is you will see what the model delivers is an overpowering intuition. And the overpowering intuition is, and I'll get to in a second, is that the correlation between stocks is key. And I just cannot imagine that intuition will change in continuous time. But again, I don't want to speculate. The problem, Marcus, is in this world, you cannot write complicated models down. You want people to read your stuff, it's got to be simple. So doing this paper in continuous time would be the death. All right, so with that piece of advice in mind, let's continue.
Thank you for this wisdom.
What do you say? Okay, so
thank you for the wise words in terms of modeling approach.
Yeah, I know. All right, so what this means is these are now exogenous quantities, which is the variance of the cash flow variances of the dirty portfolio, the clean portfolio, the covariance, and then the variance of the market. Notice that in this one case, because of the price normalization, the variance of the market and the cash flow variance of the market and the return variance of the market is the same. And the other thing to notice is that the correlation, the cash flow correlation and the return correlation are the same. But it's certainly not the case that the cash flow of anything else, the cash flow variance or the cash flow covariance is the same as the return covariance for any other asset. Okay. So now I'm going to go. We've already pointed this out, but let me be clear about it. So the clean portfolio is defined to be the portfolio of clean stocks. So what does it mean? The clean portfolio is the tangency portfolio on the constrained mean variance efficient frontier. The dirty portfolio is the portfolio when combined with the clean portfolio gives the market portfolio. And that's the sense which I mean the dirty portfolio can contain clean stocks. And the only condition under which the dirty portfolio will only contain dirty stocks is if the clean portfolio is on the unconstrained mean variance sufficient frontier of risky stocks, right? If it happens to be on the unconstrained frontier, then that will be the case. But if it's not, then the dirty portfolio will contain dirty stocks. B is the total wealth ESG investors choose to invest in the risk-free asset. So the rest of investors invest minus B in the risk-free asset. Okay. So now what I'm going to do is not put you through mean variance mathematics. And if you want to go through it, you can look at it in the paper. But let me tell you what the result is and just quickly go through it. So, so in the world with ESG investors, what you're going to do is you're going to say, okay, the global mean variance efficient portfolio prices, right? And that's going to give you a beta relation. But that beta relation is going to be with respect to the global mean variance efficient portfolio. Now, in this case, the global mean variance efficient portfolio is not the market portfolio, right? And so what this equation does is rewrite the pricing equations in terms of the market betas, not the betas with the mean variance efficient portfolio. So what you see here is an equation. The 2K sigma squared is, I'll show you in a second, is basically the market risk premium. So it says the difference in the return between the dirty stocks and the clean stocks is going to be given by the market risk premium times the difference in their betas, plus an extra term, okay? So just to be clear, if I was writing this in terms of the mean variance efficient portfolio, then it would just be the difference in the betas with respect to mean variance efficient portfolio. The reason I have that extra term there is I was able to write this in terms of the betas with the markets. And so that's why you get this extra term, because in the world with ESG investors, the market is not mean variance efficient. Okay. So the difference is a function of the differences and the risk differences between the two kinds of stocks, the dirty and the clean stocks, and as well as an extra term that reflects the fact that the ESG investors are affecting prices by, obviously, if the ESG investors take a constrained mean variance efficient portfolio, what that means is the rest of investors have to take the other side. So relative to the portfolio when there are no ESG investors, they need to tilt. And in order to get them to tilt, prices and returns change so that from their perspective, it's the mean variance efficient portfolio. And that extra term there, which I'll come to in a second, is the price differences that causes them to tilt. Okay, now, let me just quickly, in a world without ESG investors, it's a straight capital asset pricing model. And then the equilibrium is a standard equilibrium. I'm going to come to you in a second to show you why but just the 2K sigma squared there is essentially the market risk premium. I will talk about that in a second. But so then the difference in the returns between the two assets, between the dirty and the clean portfolio, is just the difference between the market risk premium multiplied by the difference between the betas. In this case, the market portfolio is mean variance efficient. So beta stars is the return, is the beta of the market portfolio. Now, the reason I put a star in there is because stars indicate the equilibrium without ESG investors. Now, this might look like, oh my God, it's what a simple relation. And, I wish it was, it'd be great if it was. But the problem here is the market betas in the world with no ESG investors and the market betas in the world with ESG investors are not the same, right? Because in the world with the prices have changed in those two worlds. And so the market betas in those two worlds are not the same. What I'm going to show you, though, is that that is a second order effect. So if you assume to first order that the market betas in the world with and without ESG investors are the same, then you get then you can subtract these two equations. So that's the difference. So I subtract the difference in the cost of capital between dirty and clean stocks in the world with ESG investors, and the difference in the cost of capital in the world without ESG investors. If I assume those market betas are the same, then I get a very simple relation between what happens to the cost of capital. It's basically just this extra term. And I'm going to show you, and the paper formally derives this and shows that the difference between these betas is second order. So first order, this term determines the difference in return. So let's see that. So what is this? What is this? And this is the main, I would say, the main result of the paper. What the paper does, I mean, a lot of other papers have been written using the capital asset pricing model, but none of them, surprisingly so, none of them focused on, let's calibrate this model and find out how big this difference is. And so what I say, the big, other than us doing that, nobody else did that. But the big difference between this paper and the previous paper is this formula. We were able to derive a really simple formula. So what's the formula? So in the standard capital equilibrium, 2K, so K is the mean variance parameter, right? That measures how much people don't like variance. That is the, so what I want you to think about this is, in a normal world with no ESG investors, then K is going to be the difference between the market return and the risk-free rate divided by sigma squared. So that's going to be the market risk premium divided by sigma squared. So I can put, so if I 2K sigma squared, if I plug it in, I get market risk premium. So think of this as the historical market risk premium in the market. Long before they were ESG investors, if I assume that risk preferences haven't changed over time, then I can measure this first term by going back and saying, what is the average market risk premium? Okay, so that's the first term. The second term is the fraction of dirty stocks in the economy. The third term is the ratio of dirty investors' wealth to clean investors' wealth, to other investors' wealth. And the final term is 1 minus the correlation coefficient squared. So now, let's just look at this formula and let's just understand the intuition of what's going on here. Okay, so the 1 minus the correlation squared is a pretty important term. And what it does is it measures the degree of substitutability. So if I go into a store and they're selling apples and oranges, and everybody is buying apples and oranges, and then all of a sudden, somebody is born and he doesn't like apples. So now he's going to be buying more oranges. And the question is, when he does that, what happens to the price of apples? Well, if other people find apples and oranges highly substitutable, it's not going to take much of a price change to get them to buy more apples. But if the other people do not find them highly substitutable, in order to induce them to buy more apples, you're going to have to get a big price change. So in a financial market, what determines the substitutability between assets is the correlation. And that final term measures, this is a measure of the substitutability of stocks. And what you're going to see right off the bat is stocks are highly substitutable. And that's going to be a big problem for having an effect on the cost of capital, because since they're highly substitutable, it's not going to take much of a price change to get people to switch from one stock to another. Okay, the second term with a gamma over 1 minus gamma is notable. Obviously, what does that do? It measures the ratio of clean versus dirty investors. And obviously, if there are lots and lots of clean investors, they're going to have a bigger price impact than if there are not so many clean investors. But another aspect of that term is that's the one term that we're affecting, right? I mean, obviously, other terms are going to be affected in an indirect way, because when we change the fraction of clean and dirty investors, that's going to then change prices, which then changes correlations and the fraction that's dirty stocks. But the first order effect is that term. So you can think of that second term as the dial, right? That's the term we're going to change, which is the ratio of clean investors to dirty investors. Finally, there's the third term, which is the fraction of dirty stocks in the economy. And so the way you want to think of this is as the fraction of dirty stocks in the economy goes up, they impose more costs on the rest of investors, right? So if most of the stocks in the world are dirty, okay, and I then sell them, right, then I'm forcing the clean investor, the normal investors to take on more dirty stocks. And so therefore they're going to demand a bigger price change. Okay, and so that's the intuition for how this term works. And what's so great about this is this tells you then the effect on the cost of capital of ESG investors. Okay, so let's do that. So now what I would like to do next is say, well, how big is this effect? So let's see, let's just see how we're going to calibrate that. So what I'm going to do is there are two, okay, let me just take a step back here. One of the problems with ESG investing is, there's no general agreement of what a clean stock is and what a dirty stock is, okay? And so, there are lots of companies going to business, making lots of money, telling everybody what's clean and what's dirty, and they don't really agree with each other. So we needed at this point to find a way of clearly defining what does it mean to be clean and what does it mean to be dirty. And it seemed to us, as financial economists, the best way to do that is to basically let people you basically use a reveal preference argument. So why don't we just look at the securities people hold? So one way of doing that is to say, okay, let's look at the indexes that the index, whatever it was, the passive index portfolios match, because at least then we know that when these indexes change, there is actually trade. So what we discovered was that there's a FTSE for Good USA index that Vanguard, the largest index, the ESG index fund in the world, Vanguard uses. So what it is it's actually really convenient. It's a index of good stocks. And what's great about it is it's a strict subset of a bigger index, which is the FTSE USA index. Okay, so the FTSE US for Good index is a strict subset of the FTSE USA index. And so these are, and so what we're going to do is we're going to calibrate this model using the FTSE for Good and the FTSE USA index. You can see that it's about 60% of the market cap of the FTSE USA index, the FTSE for Good index, and they select stocks. Okay, so with that in mind, let me just, here is how the market cap of these two indices has changed over time. But it's pretty, it's something like 40, 60 is what the, sorry, 60, something like 60% of the for Good index, 60% of the USA index is in the for Good index. Okay, and the major fund that is managed, the largest index fund in the world is the Vanguard Social Index Fund, and it has, a couple $1 billion in assets under management. So 14, right now it's up to 12, maybe it's more greater now, $14 billion of assets under management. And so there is actually money that gets, that is traded based on this index. Okay, so with that in mind, all right, so what we need to, the first thing we do is we measure the correlation between clean and dirty stocks in the last 5 years as defined by FTSE. So obviously the way we do it is we say the clean stocks are defined by FTSE, and we'll define the dirty stocks as the stocks that are in the FTSE USA index that are not in the FTSE for Good index. And we'll look, and the correlation between those two portfolios is 0.97. And as somebody almost certainly will point out, Jonathan, what about the fact that the dirty index in your theory could contain clean stocks? And I'll say yes. So this is a lower bound on the correlation. Fine. So we're going to use a correlation of 0.97, which, as you see, is very high. We're going to calculate based on the last 5 years what the fraction of dirty stocks, and it was 48.5%. So the fraction of dirty stocks based on these two indexes is 48.5%. So obviously, we're making the assumption that this fraction, so these are mid to large stocks, that when we include all stocks, the fraction will be similar. I will say that the FTSE index makes up something like 85% of all market cap in the USA. Now the question is, how many clean investors are there? And of course, this number varies all over the place. Again, what we decided to do is just use hard numbers. So what we did was we added up the total fraction of AUM held in ESG funds and compared that to the total AUM of the mutual fund sector. And you found out that ESG funds make up 2% of the whole mutual fund sector. So you're doing that, you then can calibrate this. And so we used a market risk premium of 6%, which is high, but within the realm of what it could be. And so doing that, you multiply those out, you get a difference in the cost of capital of 35 basis points. 0.35 basis points, less than 1 basis point, which I think we can all agree couldn't possibly make any difference to any investment opportunity any firm could ever do. So you might say at this point, well, Jonathan, how do you know these calibration numbers are right? And I would say we don't really. So let's just mess around with it. So one of the most interesting numbers that gets bandied about for gamma, which is the fraction of clean investors, is this number that an indice group calculates. And they get a number like 1/3 of all capital is under the control of ESG investors, which on the surface, it has to be completely crazy. We know there's no sense that clean investors control 1/3 of all capital. So you might ask, how would they get to that number? And as far as we can tell, what they do is they send a survey to various money managers around the world and ask the question, do you use ESG criteria? And if the answer is yes, they assume all capital managed by that entity is ESG capital. So if, for example, it goes to Vanguard and Vanguard says, yes, we use ESG criteria because Vanguard does have an ESG fund, then they assume all of Vanguard's capital is ESG capital. And I think that is why they get this very, very high number. With that said, if we use their number, we get the difference is now 8.5 basis points, which again is not a large enough difference to make any difference to investment decisions. Another thing we could do is look, so we used the FTSE for Good and the FTSE USA index as a measure of the fraction of clean and dirty stocks. Another thing you could do is look at the holdings of all the mutual funds that are clean, and compare that to the holdings of all other mutual funds. The problem with that, of course, is if I'm an active manager, an ESG manager, then I'm holding then in order for my stocks for a stock to be a member of my portfolio, it has to satisfy two criteria. It first has to be an ESG stock, but then it also has to be an attractive stock. So if you were to take the intersection of all the stocks held by ESG managers, what you would get is only the stocks that ESG managers particularly like. And since we're not really interested in the ESG stocks, we're interested in the complement of that, which are the dirty stocks, that complement would be too large, right? The alternative is to say, okay, we could take the union. So that's the every single stock that an ESG mutual fund holds, we take the union of all those stocks and take the complement of that. So that's the number of, so at least there we get all the dirty stock. We're getting all the clean stocks. Of course, the problem there is there's a lot of disagreement of what a clean stock is. And so by taking the union, it's basically anybody who objects to anything. But if you do that, then you get that the fraction of dirty stocks in the economy is only 18%. Obviously, with a lower fraction, the correlation goes down to 0.8, and those two things offset each other. But if you use that as a calibration, you get that the so there's a bug, there's a mistake there. That is not 1 minus 0.97, that's 0.08. That's a mistake in the slide. But if you no, what am I saying here? It's rho. What am I thinking? Okay, I have to get back to this. Yes, this is ignore the equation. This is, if you put these two numbers in rho and thing, you get 0.79 basis points. So again, you do not get a big enough sensitivity to make any difference on anything. And so the final question you would want to ask is, well, what would it take, okay, given the current parameter values in the economy, what would it actually take to for ESG investors to materially affect the cost of capital? Okay, so now, of course, in this case, we have to be careful because if I'm going to increase the number of ESG investors substantially, then obviously the equilibrium changes. So here's how I'm going to do this. I'm going to take the current parameters in the world, use them to infer the values of the exogenous parameters, right? Because I don't get to observe the cash flow variance and the cash flow, but I do get to observe the return variance. But within the model, I can say, okay, in today's world, if I have this return variance, what must the cash flow variance be? And so that's what I've done. And so then once I know the cash flow variances, the cash flow expectations and all of that stuff, I fix that. And then I say, okay, what if I not change the number of ESG investors? How will the equilibrium change? And how many ESG investors do I need to materially affect the cost of capital? And so here is that picture. So what you can see is this axis, the horizontal axis is the fraction of ESG investors, and the vertical axis is the change in the cost of capital in basis points. And what you see is, in order to get a 1% change in the cost of capital, you need 85% of ESG investors to become ESG investors. So you need an implausibly high number of investors to go green in order for this strategy to work. The other thing I might add is, in this case, since we, obviously in the model have a nice simple formula for the difference, but that's just an approximation. In the model, I know the actual. And so what I've done here is plot both the actual and the approximation. As you can see, for the current parameter values, the approximation is incredibly accurate. So we don't have to worry about any approximation errors to any of the previous things. Okay, I'm going to stop for a moment and see if there are any questions. Yes.
Jonathan,
yeah.
Hi, George again. A silly question. So you have a model which tries to explain what is the effect of divestment to the expected returns of dirty companies. So intuitively thinking, I would expect to see in the model the divestment action, if you like. Now, my understanding is that you capture this divestment action through the rho coefficient, the correlation, which measures the substitution effect. Is that so implicitly you assume that the correlation captures this divestment action, but the correlation could also be the result of any other kind of effects. So is it fair to attribute this divestment through correlation?
Well, so you're right. There's a lot of things that affect correlation that have nothing to do with ESG investing, right? So the way I want you to think about this is I take the current world, I get to measure in the current world what the current correlations are, right? I mean, the good thing about the correlation coefficient is the return correlation and the cash flow correlations are the same, right? So what's nice about that is I can say, assuming the only thing that happens is investors' preferences change, but the underlying world stays the same. So I can assume the correlation stays the same. Obviously, the covariances will change. Covariance of returns will change because there's a new equilibrium, but the correlation stays the same. So then I say, okay, all I do is change the preferences of investors. What will happen? That's what this exercise is doing. See, what happens is investors will, as I increase the number of ESG investors, then the rest of investors are forced to hold a portfolio that's further and further away from the mean variance efficient portfolio. Now, in the beginning, they don't really care because a well-diversified portfolio is a well-diversified portfolio. It doesn't make too much difference to them because of this high correlation coefficient. But eventually, it is going to start making a difference. Eventually, they're going to be forced so far off the global mean variance efficient portfolio without ESG investors that you're going to have to see price changes. And that's what's going on here. But we're just saying that happens only when 85% of investors are ESG investors.
I see. So basically, the key parameter, if you like, in the model is the fraction of green to dirty investors in a way. So it's like, yes, in a way this early model by Zechner and Krauss, yes, in JFK, right? They had the same message, yes, in early 80s.
That's a very good paper. That's a very good paper. My feeling is that paper was, all the papers following that paper seem to have gone off the deep end. Now, the problem in that paper is they weren't calibrating, And so what happens is if you write a theory model, obviously you want to draw pictures to show how the theory works, right? So they pick parameters so the pictures, there are large effects in the pictures, right? But there was no sense in that paper that the parameters matched real world parameters. Then everybody sees these pictures, and ever since then they've just been assuming that these parameters are correct parameters. What's surprising, and I have some views on this, what's surprising is nobody ever took a step back and said, no, wait a minute. Instead of making pretty pictures, let's calibrate the model to the known values in the economy and see what happens. So if you do that, you don't get the same pictures. And the Krauss model is exactly this model. It's the capital asset price model. I mean, as far as the theory is concerned, the only innovation we have over that paper, which is 20-something years old, is that we come up with a simple approximation. Okay, so the next step then is, okay, what about, does this work empirically? And so now, again, I mean, I have some thoughts about this. I have to say, guys, I have some thoughts about this, and I might share them with you. What do I have? I have how many minutes? 10 minutes left. So I'll share the thought quickly, and then I'll quickly do the empirical work. But it is odd to me that both in the theory model, nobody bothered calibrating, and in the empirical work, so the empirical work is characterized by people doing things like looking at ESG and non-ESG, using a risk model to control for risk, and then looking at differences and then making inferences about whether there's an effect, okay? And so there's lots of work on this. And what you find is that the SIM stocks outperformed. And if you look at a sample, you find that that's true, okay? In the beginning of the sample, and then they underperform in the second half of the sample, and various papers then make claims about what this means for sin stocks and non-sin stocks and that kind of thing. Well, I mean, my view of this is, look, guys, these industries are very concentrated industries. They have very different risk characteristics to the rest of the world. And so in order for this to work, you better have a damn confidence that you control for risk. I have no confidence that anybody can control for risk. So when you find differences, it seems to me you can not with any confidence say that the differences have anything to do with ESG and might just not reflect mismeasured risk. So with that in mind, we thought, well, how would we go about, and here's the full sample, by the way. If you look at the full sample, what you find is there's no statistical difference. But it depends on what sub-period you look at. So the question is, okay, how would you go about trying to determine if there's an effect of ESG investors without having to take a stand on the risk model? And so again, it seems to me that maybe you tip your hat to the corporate world and corporate finance people, and you say, why don't we think of this in the corporate finance context? So what we're going to do is we're going to do the following. We're going to do an event study, essentially, okay? And the study will be, we know that the FTSE for Good index and the FTSE USA index has make changes in how those indexes are comprised. And it is somewhat surprising, but there are quite a few changes, right? So over the sample period of the last 20 years, there were 248 additions and 163 deletions to the FTSE US index. And at the same time, we had 204 additions and 94 deletions to the FTSE for Good index. And I'm going to show you in a second, these don't overlap. So there were active decisions being made about what is a good stock and what is a bad stock over those index. And I'll show you in a second that these things do not happen at the same time. So the only explanation for why it is that a stock is added or deleted for the For Good index is some corporate event has occurred to that stock that's either made it a good stock or a bad stock, right? And to show you what I mean here, so this is an index of the two indices, and you can see on the horizontal axis is how long the stock has been in the USA index over the sample period, and the horizontal and the vertical axis is how long it is in the For Good index. Obviously, if you're on the diagonal, then it means you are in the For Good index and the regular index the same amount of time. But what's important about this picture is to see that there are lots of stocks that are not on the diagonal, right? There are lots of stocks that are in the USA index that are never in the For Good index. But more importantly, there are lots of stocks that go in and out of the indexes. And what we're going to do is say, okay, fine. So if these corporate events are occurring and there is an effect on the cost of capital, we should be able to observe it when the event occurs. And so that's going to be the next step. So that's what we're going to do. We're going to say, we're going to get the return data on all the stocks in the CRISP universe. We're going to define the following dummy variables, right? One, if it's in the US index, 0 otherwise. One, if it's in the For Good index, 0 otherwise. And recall that the For Good index is a strict subset of the regular index. So if the For Good index is on 1, then the US index has to be on 1 too, okay? Then I'm going to define the following changes, the delta variables, which is the difference between the difference between the index today and the index yesterday. Sorry, the difference between the dummy variable today and the dummy variable. Yes, the difference between the dummy variable 1, 0, and then it goes, yes, the difference between the dummy variable yesterday and the dummy variable today. So what does that give you? It's +1 so for the regular index, it's +1 in the quarter when the stock's added, -1 in the quarter when the stock's deleted, and 0 otherwise. And the same thing for the For Good index. +1 in the quarter when it's added to the For Good index, -1 in the quarter when it's deleted, and 0 otherwise. Okay. And so then we just run regressions. And what do you find? Well, the first thing to notice is, okay, so I'm going to now look at two things. I'm going to look at the return on the day, and then obviously, so the two dummy variables measure two different things, right? The main dummy variable measures the return differences when you're in and out, and the delta dummy variable measures the price effect. Now, obviously, you should see both, but we understand that the price effect is going to be much easier to detect, right? Because it's the capitalized value of all future growth differences. So if we're going to find an effect, we would expect to find it strongest in the price differences. And what you see is that there is no effect when you get a well, I wouldn't say no effect. There's a very, very, very small effect of 24 basis points, which is about what we expected based on the theory. We expected there to be a small difference, and we expect the difference to be on the order of in the basis points. Of course, that was in the theory. It is it's a difference in returns, where this is the capitalized value, the difference in prices. So a 24 basis point capitalized value is going to be a very small return difference. So in fact, yes, we get exactly what we predict, a very small increase, a very small difference in the cost of capital. Notice that you do in fact get like all indexes, there is a price effect when a stock is added to or subtracted from the index. And so the main dummy variable for the US index, you see a small price difference, but and you see and you also see a price change for that. But the most important thing is you do not see any effect on the inclusion or exclusion decision for an inclusion or exclusion in the for good index. And so let me just finish by just commenting on what I was going on in the future. It is worrying to me. Look, this paper, I mean, I like the paper and I think it's a good paper, but let's be honest about this paper. It's not, I don't, as a financial economist, it's not like I started writing this paper expecting anything different. It seemed pretty ludicrous to me that, a couple of investors divesting is going to make any difference, a big enough difference to the cost of capital to change corporate policy. And so the question you might want to ask yourselves is, why did this paper take so long to write? And by the same token, why did the inclusion exclusion effect take so long when, and I think we have to worry as a profession about this, because I think, to me, it seems to me the most obvious explanation is that in a world where, there's a lot of press, a lot of attention for climate and social outcomes and virtue signaling, it seems to me that there was a pressure within academics to find the effects. I mean, maybe because those are papers that get a lot of attention and are easier to publish, but it is kind of worrying to me because it does mean that our, the scientific method is being influenced by exogenous factors like what's popular to find. So I will end with that observation.
Well, thank you, Jonathan. That's actually a perfect landing on the 5:15, and I think there's no there's no need to ask for another closing word. So let me, with that, thank you very, very much for your talk today.